We first start off with the concept of selling debt. Countries and corporations all need to find ways to raise capital to finance their needs. One way in which they are able to do this is by selling their debt on the open market. So they take the money they need to raise and convert it to a debt security. By doing this, they're able to give their debt a formal financial and legal status. Then they sell this debt to individuals on the open market, and individuals buy debt because they know that eventually they will receive the original portion of the debt that they paid, the principal, as well as the interest or the fee for financing that debt in the first place. So one can technically profit off of a country or a company's debt. But what's the catch? Well, there is a risk that a borrower who issues out the debt might not be able to pay it back. To prevent this from happening, this is where a credit rating agency steps in. A credit rating agency evaluates the debt and the qualities of the debt issuer. It looks at the ability of borrowers to pay back this debt, how much outstanding debt exists, and the overall financial and general health of this entity. It then assigns a range of ratings to this debt of investment grade or junk quality. The highest category of this range, which is usually investment grade, is high quality, and the lowest category is junk grade, which is poor quality. In the financial world, these are the three most prominent credit rating agencies. They are Standard & Poor, Moody's, and Fitch Ratings. This is an example of long-term debt for the three prominent credit rating agencies. They all evaluate debt with an assortment of letters and numbers, with more A's and lower numbers corresponding to a better rating. As you can see here, the highest quality debt is given AAA status by all three agencies. But why are these funds so important? Well, remember when I was talking about the giant pool of money? They had a lot of funds such as pension funds, sovereign funds, insurance funds, etc. Well, because these funds were on behalf of important institutions such as teachers' unions, states, countries, insurance companies, and they were looking for low risk, therefore they could not afford to gamble their money. Furthermore, there were many laws that restricted these investments to only high quality, as these were the least likely to default. If the debt was downgraded, these low-risk investors could not legally invest with them. Thus, ratings are important because every time debt is downgraded or lowered in quality, it affects the number of eligible investors. It is important to note that just because a debt is not rated high quality does not mean it is not sellable. Many times this low-quality debt, while riskier, has potential for higher returns. It therefore can attract the likes of investors in places such as hedge funds. Now you remember this diagram where investors had to buy mortgage-backed securities from banks. Because these mortgage-backed securities were debt, investors, especially those in the giant pool of money, needed to know how it was rated because, as said before, they could only purchase high-quality debt. The problem with these mortgage-backed securities was that the mortgage pool was changing. First, there were these A-paper mortgages, which were good. But then, remember, there were other mortgages being added to the pile, such as Alt-A and Subprime. With A-paper mortgages, there was data and statistics to see that the rate of default and risk associated with purchasing them. With Alt-A and Subprime, there weren't as many statistics or historical data. So the problem with many credit rating agencies was that many hadn't considered the fact that the mortgage pool had changed in quality and possible rate of default. They looked at A-paper mortgages and saw that the rate of default was very small, and so they rated mortgage-backed securities very highly. But what they didn't consider was the fact that Alt-A and Subprime were a lot more risky. The inability of credit rating agencies to recognize the inherent risk of some of these mortgages caused them to come under a lot of fire when many of these mortgage-backed securities collapsed. It also brought up some of the inherent problems associated with these agencies. First, there's a conflict of interest. Most credit rating agencies are not fully objective. Before, they used to make money by selling their ratings to companies. Nowadays, they work very closely with the companies and other organizations they rate. Furthermore, there are many barriers to entry for lesser-known credit rating agencies. Unless you're a well-known credit rating agency, most companies don't pay attention to your ratings, especially if you lower or downgrade a company's ratings. Furthermore, ratings don't change quickly enough. This was seen in the case of Enron, where its ratings were downgraded literally a couple days before they declared bankruptcy. To review, credit rating agencies gave mortgage-backed securities solid ratings because they used data regarding A-paper mortgages. When a lot of high-quality investments had problems with defaulting, CRAs came under intense scrutiny and criticism. The current crisis reveals the inherent problems associated with credit rating agencies in general. Coming up, how did the high savings in China play a role in the current crisis? Thanks for watching. To learn more or watch more podcasts, visit www.subprimethemusical.wordpress.com.